So that covers basically how to account for these instruments over the course of time that we hold them. Now the next part that we want to look at, and this is a part that your book doesn't really cover in detail, and it's a part that's not covered in a lot of classes, but I added it because I think it's really important. If we have an investment, you got to know what to do when you sell it, because that is part and parcel with most investments, right? Unless we're holding it to maturity, we're looking to cash in on this thing most likely at some point, and the journal entry to record that isn't necessarily that complex. It's just a variation on a theme that we've seen to sell most assets, but there are some special considerations to consider. So when we sell it, the debt security is going to be sold for the fair market value of the security, plus any interest that has accrued from the prior interest payment up to the day of sale. So there's two, really you can think of it as two components. This first part is set by current market rates. So remember that when we account for the debt security in question, we use a so-called historic market rate. That is the market rate on the day that we purchased it. And we use that market rate, we lock it into place, and we use that market rate in order to determine interest revenue. That interest revenue indirectly then determines how much amortization we're going to show on the discount or premium of that security over its life. But market rates are continuously changing in reality. And so when we go to sell our investment, we're going to sell it at the current market rate, which will set its fair value. We're going to add to this any interest that has accrued from the prior interest payment up to the day of sale. And so what that means is if the last interest payment was received on December 31st and we're selling the item, say, on June 1st, we'd have to account for the 5 months of interest that had accrued because that is interest that we are due since we've been holding it. Now, interest payments are only paid on specified dates by the owner or by the person whose debt it actually belongs to. That is the borrower who we originally bought this item from. Because we're not necessarily selling it back to the borrower, the original borrower. We just might be selling it to another investor. And what they're going to do is accrue the next total interest payment from the borrower. And so unless we get a compensation for the amount of time that we've held it since the last interest payment, we aren't getting paid our due. So again, why does this make sense? Well, just think of it in a really extreme example. So if you're on a timeline and if interest is being paid on March 1st of a year, so March 1st is my interest payment date, and we buy a security, let's say on a year that is not a leap year, but on February 28th, and we're not the first owner of this security, right? So we buy a security on this date, and the interest is going to come to us, since we just bought this, the next day. The thing is, we are going to get a full interest payment on March 1st. Now, do we deserve that full interest payment? No. Really, we deserve the interest payment of 1 day. So that's the only amount, that's the amount of interest I should get. So what I'm due is interest that is 1/365th of the total interest. And what the person, the buyer, right, if we are the buyer, we're due interest of 1/365th of the total interest. And the person who sold it to us of 364 of 365 of the total interest. So then what we're going to do as the buyer of this, we're going to pay them an extra whatever 364 divided by 365 times the total interest, showing that they basically get the entire interest payment. So we pay this when we buy the security, then we receive on March 1st, all of the interest payment, right? The total interest payment, because again, it happens on a specified date and it all goes to whoever holds the interest on that day. So if you see, we're going to receive this in cash. We are going to pay this, and then we're going to net the amount that we're due, right? We receive all 365 of 365. We pay whoever sold it to us 364 out of 365, and then we are then due the amount we will receive, only what we're due, which is the net of those two, 1 out of 365 days. Let's look at it on a less extreme example. Whenever we do this, whenever we're selling a security, we want to consider a few things. Let's see if I can fix this autofocus problem. Been having issues with my camera. It'll focus on my hand. No. There it goes. Whenever we do this, then we're going to have a few things that we're going to want to remove from the books. When a security is sold, we want to remove the historical cost of the investment with a credit. Right? So the historical cost goes out, which means that we are, in these transactions, going to credit the investment account at face value. Because remember, we put it in there at face value. We're going to keep it in there at face value. And then finally, if we sell it or it matures and we're paid, we get to remove it at face value. We want to get rid of any amortization or premium, any unamortized amount of discount or premium. And this is sort of like removing accumulated depreciation from a fixed asset. Once we sell the investment, we have no more use for a contra or an adjunct account that bases itself on the investment account we just eliminated. And note that when we remove both of these, essentially what we're doing is removing the carrying value of the asset. Just like when we remove accumulated depreciation and the historical cost of a fixed asset, we're removing the book value. We're going to remove any interest receivable that has been accrued, and that's also going to be paid off by the sell price. So that's going to be a credit to interest receivable. And then any value of the sell price, that is the cash, over or under these amounts will represent our gain or loss, right? So that's the final item, is a gain or loss on the sale. And of course, the cash is the sell price. We would record the cash as well. So suppose that Crisco sells these AFS bonds on March 1st of the third year for a price of $982,000, right? So if they sell it for $982,000, and that includes an adjustment for interest payable up to Chris to that date. The first thing we want to do is figure out how much interest Chris is due. So remember, in this case, these bonds that we've been using as an investment for all these examples, they last paid interest to Chris on 12/31/17, and now we're going to sell them on March 1st of the third year, which would be the 2018. And this is the amount of interest Chris is due. Remember that the buyer of this is going to receive all of the interest on the next payment, but the buyer is only due that amount. So what the buyer will do is pay us this much they'll receive everything at the end of this year. And since they receive everything and pay us this much, then they net only what they are due. So that's why it works out economically. Let's go ahead and record how that would occur. The carrying value of our investment at that date is going to be $987,566, at least on January 1st, 2018. And it is in your amortization table. We calculated this amount. But if you didn't know this amount, it would be really easy for you to determine it. You would use a future value of $1 million, a payment that's equal to the fixed payment Chris has been getting, 99.5% of that, which is $95,000. The market rate of interest that we've locked in is 10%. That's the interest that we had when we bought it. Well, the only thing you really have to change then is N. And you have to realize now that if we're in our third year, there have been 2 payments, right? At the end of 12/31/16, and then again at the end of 12/31/17. And so after that second payment, N has been knocked down to 3. And if you calculate the present value of this at that point in time, it will give you the carrying value. And that's that shortcut I talked about the other day. Right? So this is the carrying value we're working with. In order to determine the update of interest, we need to record interest revenue for 3 months, or I'm sorry, for 2 months, only January and February. Interest receivable, because again, that payment, the cash payment comes at the end of the year. We're not going to get paid cash by on March 1st with this entry. We'll get paid cash when we sell it. So we'll work that in there. And then there's going to be a bit of an amortization to the discount when we make this entry. So we just do some slight adjustments. If we were going to record interest revenue for an entire year, we would take $987,566 and multiply it by 10%, and that would be our interest revenue for the whole year. But since we're only holding it for 2 out of 12 months, we only record it for that partial part of a year, which turns out to be $16,459. And that becomes my interest revenue. Now, interest receivable is going to be calculated the same way a stated payment would, except that, again, we only want 2 months. So for the full year, our stated payment would have been $95,000. Multiply it by 2 out of 12 months, and that gives us $15,833. That's an 8, and that's a little hard to read. So that $15,833 and the interest revenue $16,459. Now we just use the discount as the difference between them as our plug in this, and that gives me the amount that we would amortize the investment by for that short period of time. And that's important to know because we need an updated carrying value at 3/1/18, right? So the discount on my investment started at a certain amount. We are going to debit it by 6/26 and then determine what the balance will be. What was that amount? Well, again, I want you to be comfortable using the face value and the carrying value to determine where we were. So this was something we entered in to get a March 1st, 2018 value. We need to know where we started at here. Well, how can I figure out the discount? Remember that the face value minus the carrying value will yield a discount amount, right? So face value is 1 million. The carrying value is 987,566. So that was at the beginning of the year. That gives me the discount for the beginning of the year, which would turn out to be 12,434. And again, you should be comfortable doing that and picking up a discount at any point along the line when you can modify this formula to get a carrying value at any point in time. Right? So now we have an updated discount. We only have 11,808 after you reconcile that T account. We can now move to the actual sell. So this was just updating the carrying value to the day of sell. Now we actually move to the sell. We get cash of 982 for this. And the first thing you want to think about is, all right, this cash payment wipes out all of the investment accounts on my balance sheet or in my ledger, right? So remember that the investment, and we're treating this as the AFS investment, was valued originally at $1 million, and we kept it there at its face value. Now we also have this discount account that we want to zero out. We zeroed out the investment account, we zeroed out the discount account, so we've taken care of that. But this 982 also pays us for this accrued interest receivable at that date. So we want to credit that amount because now we are receiving payment for it. Remember I said, well, you're not receiving payment for it, when we're doing this journal entry, the thing that you're receiving payment for is with this 982. Because otherwise then, oops, I just wrote 982, 15,833. Otherwise, if you had recorded this as cash, you would have already been paid for this amount and you might have double counted cash. So be careful with that. First, it's interest receivable, then you wipe the interest receivable out with a credit. And now all we have left then is the gain or loss on sell. You total up your debits, you total up your credits, and then you determine the missing amount, which the loss on sale becomes $22,025. Now, if this is a standalone security, we're not manipulating a portfolio of these securities, which we'll look at how that's a little bit different on Tuesday. But if it's a standalone security, there's one more thing then you would want to reverse, and that is the fact that there has been an outstanding gain or loss that has been unrealized and affecting OCI. Remember that we have also a security fair value adjustment account related to this available for sale security. And we can't have that on the books still. So what we do then is reverse that. We recognize a debit here to my AFS, security fair value adjustment, and that debit correlates to an unrealized gain of the same amount that will flow through OCI. Now you might say, why am I doing that? This doesn't make any sense that I would recognize a gain when I had a loss on sale. Well, this gain, remember, if we had been recording unrealized losses in OCI, we would have had a $24,000 loss in OCI, a 20,585 gain in OCI. So we originally had that loss, 24,151. Then we had that gain, 20,585. Well, we came out at a loss still of 3,566. Now, don't get confused. I know this is a credit balance, but whenever we're reflecting a credit here, right, then that means we have debited a loss. So when you're thinking about what these got closed out to, these all got closed out to AOCI. So this loss created a 24,151 debit balance in AOCI. We then closed a 20,585 gain to AOCI, and when that happened, it dropped down to a 3,566 debit balance in AOCI. So we need one more gain in order to completely wipe out AOCI. that's going to be done when we close out this gain to AOCI. It'll zero out that account. Right? If you don't follow that, then just know you have to do it and reverse it, because you don't want the security fair value adjustment account remaining on your balance sheet. The AOCI link, I understand, is a little bit high level, and it incorporates a lot when I'm already asking you for this. So make sure you get this down and understand this loss transaction, how to update the discount account, and all of that before you worry too much about why you're doing this. I'll let you guys do this the first part of class. We'll talk over strong company first part of class. And then I now have a little bit more to talk about with Module 18. So this is kind of Module 17.2 / Module 18. And I won't go too far into Module 18. I'll let that be Module 18.2 lecture. But now we're going to shift our focus over into accounting for equity securities. And I believe you're going to find the accounting for equity securities to be significantly less painful than the accounting for debt securities. And the big reason for that is we no longer have market rates and stated rates. We no longer have present values, because the present value is always set by what the equity is trading at. We don't have this sort of complex relationship between an interest rate and a value, which is kind of counterintuitive. But we do have a different sort of intrigue, if you will, when it comes to equity securities. We have accounting based on the influence of the amount of ownership. So we either have what we call no significant influence, or total control. And that depends on the percent ownership you have of the company. If you have less than 20% ownership of the company, we say that you do not have significant influence, and we tell you to use what we call the fair value method. Right? The fair value method is just based on price increases or declines in the stock market. So you are just a, standby trader. If the value of your stocks declines, you recognize a loss. If the value of your stocks increases, you recognize a gain. And you don't have real significant influence in the company. You're just buying it for those capital gains appreciation. The significant influence occurs when you have between 20 and 50% ownership. We use something called the net equity method, and we begin to bend the accounting more from an owner standpoint. And so your gains or your revenue or your losses from this investment are no longer based on just the price fluctuations in the market. Rather, they're based on the amount of income that comes into the company, and we treat the investment as a proportional amount of the net assets of the company. We'll look a little bit more at equity method in 18.2. We're going to base most of our discussion, or all of our discussion, on the fair value method in this part of the lecture. Absolute control occurs when we have more than 50% ownership. That means we have to consolidate financial statements, and this is going to be a topic for advanced financial accounting. There's a good amount of information that goes along with what happens when one company acquires a majority ownership in another company, and we want to cover most of that in advanced accounting. So looking at the fair value method, again, our idea is that we have no significant ownership. We have less than 20% of the total outstanding stock of the company. So we can't influence the board of directors. We can't really throw our weight behind any sort of decision. We have two available classifications for available for sale securities. And again, remember that for now, up until December 2017, available for sale will be a valid classification for these securities. However, after that date, it'll only be trading securities. There are not many differences. The only differences reflect those differences we've already seen with investments in debt securities. When we purchase them, we record them at cost. Very straightforward. right? The amount of money we pay is the amount of money we recognize the asset for. When we receive dividends, we recognize them as dividend revenue. We mark them to market at the end of the period, just as we did with debt. And any unrealized gains or losses will affect net income for a trading security, will affect OCI for an available for sale security. And then when we sell them, we'll just receive an amount of cash, credit the investment at its historical cost, and then recognize a gain or a loss for any difference. Right? Pretty easy. So let's look at an example. Suppose I have two portfolios of securities, of equity securities. I have trading securities that represent security interests in Samsung and Apple, and available for sale securities in Harley and Kawasaki. We're assuming that none of these have significant interests, and so we're going to use the fair value method to account for them. So we're going to first look at preparing journal entries to record the purchase of these investments. I have the cost at the beginning of the year for both portfolios, and that's all we need. So we would record investment in trading securities, investment. We don't even need two journal entries. You could do it in two journal entries if you wanted. $55,000 for the trading securities, $131,000 for the available for sale securities, and we would credit cash for that purchase, which would be $186,000. See, no present value, just straight cost, very straightforward. Suppose that Harley paid $2 of dividends per share. Well, then we look at Harley, we'd see that we have 3,000 shares, and that would be $6,000 in dividends. And we would record it as investment revenue. Of course, we receive cash for $6,000, and investment revenue dividend revenue would be better, of $6,000. Remember, dividend revenue is a non-operating income statement item because it's not part of our central operations. Now, the next part is where it could get a little trickier. We want to prepare journal entries for the year end 2016 and 2017. So one thing to understand, again, is that we are going to use, in valuing a market adjustment, we are going to use a security fair value adjustment account for both. And you want to keep them separate. What you really need to focus is that we had a historical cost for both of these, right? We have investment in AFS for $131 and an investment in TS for $55,000. So what we're looking at is, for the end of the first year at 12/31/16, I can do a total adjustment. I don't have to do it on Samsung and then Apple. I can just do 55 to 58. So I want a $58,000 balance for those. For my available for sale, I want a $189,000 balance on my balance sheet because I want these both to be represented at their market value on the balance sheet. So in order to get there, you ask yourself, what adjustment do I need to make? Well, you would make a $3,000 adjustment, wrong side, $3,000 adjustment for your trading security, right? $55,000 plus its adjunct account gives me $58,000 overall. And over here, I'd want to make another positive adjustment, in this case, a $58,000 positive adjustment to my security fair value AFS. Then just go ahead and record those 2016 entries. I would have the security fair value adjustment trading security for 3,000, and an unrealized gain. For the AFS, security fair value adjustment, 189, and an unrealized gain. For 2017, I have a market value of 70,000, which we'll deal with this first, and then we'll come to this because notice now we've sold one of these securities. Right? So at the end of the year, I have a market adjustment for my TS. I want to get them to 70,000. Well, 55 plus what will give me 70, right? That would be 20,000. Now, is that my adjusting entry? Be careful. No, it isn't, right? And I did this on purpose because now we see that, oh, I have 3,000 in here already. So how much of an adjustment do I need to make in order for this to come to its appropriate debit balance? Oh, I'm sorry. Oops. No, I was like, that's not working out. In order to get to 70,000 from 55, we need a $15,000 balance. Be careful. 55 plus 15 gives me 70. So that's not the adjustment I want to make. That's the balance I desire. That means that I need to adjust it by $12,000. That $12,000 adjustment gives me a 2017 entry, security fair value adjustment. And an unrealized gain of the same amount. Notice that this 12,000 is the difference between 58 and 70, but it doesn't, that difference between 58 and 70 is not the balance that you set to get the change between those two numbers. So it's a little tricky, and you have to know the balance because then you got to know where you're starting from in the next time and ending up in the next time and so on. All right. On this next one, we have a sale. So I want to go ahead and account for that sale first. When we account for a sale within a portfolio of securities, we're just going to account for the sale very simply, not worry about backing out anything that's in this account. All right. So first we'll account for the sale. It sold for $95,000 on March 1st, 2017. And it was purchased for $50,000. So when we record the sale, we get cash of $95,000. We want to record Kawasaki being sold at its historical cost, which was $50,000. The difference between those two then is my gain or loss. And in this case, I had a gain on sale for $45,000. All right. So I just made an entry to my investment account, right? This goes down by $50,000 before the end of the year, which is when I make the fair value adjustment. So now I only have the cost of Harley left in there, right? When I go to value the security fair value adjustment account at the end of the year, I realize that since one of them is sold, I have now a balance of $110,000 that I want to achieve. In order to achieve that balance of $110,000, I want to look at where my historical is starting. What do I need to get there? So it looks like I need $29,000 of a debit balance to get there. What do I need to adjust the account then to get to my desired balance? Well, I need 58,000 less 29,000. What I need then is a $29,000 credit. So now I'm balancing my security fair value adjustment account. I would have an unrealized loss of 29,000, and that is my security fair value adjustment credit. Right. So some of you might say, well, hold up, this doesn't make sense. Let me fold the paper sort of origami style here maybe and see if I can't help make some sense of this. All right, so folding this up so that we eliminate the unnecessary stuff, and I still don't have it all on one screen, unfortunately. When we sold this Kawasaki, why did we have a huge loss here, you might ask? If you look at what happened to Harley, well, there was only a $4,000 loss between 114 and 110. Why isn't it just 4,000? That doesn't make sense, right? We recognized a $12,000 gain. That made sense because my portfolio swung from 58 up to 70. Well, we did have a $4,000 loss in Harley, but Kawasaki, right, had already a $25,000 gain that was in my OCI account. Remember that when I recorded the gain in the prior period, and I recorded it incorrectly, I just noticed that, hopefully you didn't hear me curse. It shouldn't have been 189,000, and I'm sure y'all were all like, oh my God, what is he doing? It should have only been 58,000, right? Because that's the entry here. This is the balance sheet amount of 131 plus 50, which equals 189. So within this 58,000 that I recorded is $25,000 of a gain from my Kawasaki security. So I have to reverse that since it's no longer an AFS security of mine. So this 29,000 is really a $25,000 reversal and a $4,000 loss due to due to Harley. So there's two things that are moving in this, and that's why we just record this gain on sale, even though we recognized $25,000 of this gain in a prior period as OCI, because we're going to reverse that out and now recognize the whole gain in net income. And that's where this gets a little tricky. And I'll talk through this again in class, but make sure you kind of get the nuts and bolts that once an AFS security is sold, then we want to reverse anything we've already recognized and then recognize the entire sale at the day of sale. The income statement effects for 2016 and 2017 will flow from our entries that we've made. So for 2016, we have to include these dividends from Harley. Remember that dividend revenue is going to be non-operating revenue. In 2016, we have these two entries. We have an unrealized gain of $3K. And that's my net income effects. And then I have an OCI effect with that $58,000 gain. in 2017, I have no dividends, but I have an unrealized gain here of 12,000. And then I have a gain on sale of 45,000. And remember, no matter what they are, trading or AFS or even HTM in the case of a debt item, a debt investment, all of the actual sales are net income related. And then I have finally an unrealized loss that would go to my OCI. And what are the carrying values on the balance sheet? That is the easiest question of all time, especially for an equity or any trading and available for sale security on 12/31/16 and 12/31/17. On 12/31/16, we would have a TS account of 58,000. We'd have available for sale account of 189,000. And we'd have an investment in TS account in the next year of 70,000 and available for sale account of 110. And all I'm doing is just taking the market values of those instruments and plucking them down. Right. All right. So that is that part of equity. We'll look at what happens when we have an equity method investment in the next video. And if you have any questions, of course, email me. Otherwise, good luck.